How do you define liquid alternatives?
The only thing I would add on to that is, our approach is alternative is the key word there, and you're looking for asset classes that provide a uncorrelated revenue stream to standard long-only mutual funds or any other type of mutual fund vehicle. Now they're so diverse; it's everything from real estate, private equity, long-short, managed futures that covers that space. I think the main key is that it makes asset or investment vehicles that weren't available to the average public. Now it becomes available. And I think we have to eliminate this idea that you have to have money to make money. These type of investment vehicles were never available to people unless they were accredited investors. Now you're starting to see them become available to the average investor, which I think is key. It allows those people to get an uncorrelated revenue stream in their portfolio.
That's right, a lot of hedge fund minimums range from what, 1 million to 5 million? So.
Well, and not only that, but you have to have a certain amount of assets before you're even qualified to invest in that type of fund. I mean, even if the minimum is as low as 100,000 like our vehicle, you still can't invest unless you meet the qualifications of accredited investor.
Sure.
So the minimums on a liquid alternative is much lower, and it doesn't require a person to be accredited to get that investment.
So first two kind of focused on the liquid part. You brought us over to alternatives, but overall just a wider array of investors are now available to have strategies that they otherwise wouldn't have. Given this, and given that hedge fund strategies have long been sort of inaccessible, how have you seen the investor demand for these types of strategies grow since they debuted?
Oh yeah, we've seen a lot of growth. Since the credit crisis, especially for our firm, which, like Laura said, has not been a very positive environment for the managed futures space, and yet we've done well. Our firm is a little different because our background is in the LP space, and so venturing into the 40 Act space has been new for us. So we've only been involved for the last several years, but it's been the fastest growing space that we've been in. We have both a UCITS fund we trade for and a 40 Act fund, and those two have grown much faster than any of our other investments.
A lot of advisors want to allocate to managed futures. They had a really stellar year recently, but now there have been some headlines of underperformance. How do you explain it to investors?
Well, I think it actually applies to all three of us. People have to remember why they invested in the strategy to begin with. I mean, that hasn't changed. It's still non-correlated, and it still provides you protection on the downside, credit crisis type protection. 2008, I don't know how the other strategies did. We did very well. We made 50%. So from the investor's point of view is they have a hard time watching the rest of their portfolio grow and this part of the portfolio not perform well. So the idea is that they have actually purchased insurance, and the cost of that insurance is the opportunity cost that they're foregoing by not being invested in something else. We've actually done okay, so we've performed equally to the S&P during this time, but there's periods during that where you're not going to perform. It's uncorrelated. Now, don't equate uncorrelated to negatively correlated. Doesn't mean if the S&P goes up, we're going to go down and vice versa. It just means there's no way of looking at your rest of your portfolio and determining how our strategies will do, because it's not correlated. They run independently. So you got to look at your portfolio as a whole. Even when we're not doing well, if we're making money, we're actually reducing the overall risk of the portfolio. So their risk-adjusted returns have actually increased, even though they look at this one line item and think, why did I invest in that?
Yeah, that's a great addition. And you mentioned that one of the advantages of the liquid alt structure is that it's kind of a democratization of alternatives. It's a good phrase. What are some other specific advantages or disadvantages to the 40 Act structure itself?
From the liquid alts point of view, managed futures is absolutely the best vehicle. I think there's a little bit of a problem in the space where there's two keys that I think should be required. Now, all of us here meet those requirements. It should be totally transparent from a pricing standpoint. So everything that we trade is priced on a regulated exchange by the second. So there's no question of what the value of the assets are. Secondly, the entire portfolio could be liquidated in 24 hours without any problem. So you got complete liquidity, complete transparency on the pricing. There are things out here in this space associated with real estate, private equity and things that aren't that way. So I question why they would be put in a 40 Act wrapper. I think there's been some pushback on the managed future space from a regulatory standpoint related to exposure to commodities, which I don't really understand. I think they're behind the times and haven't really caught up with what's going on in today's markets. And that's a detriment to the investor, because by expanding the exposure across uncorrelated markets, commodities, for instance, are much different than equities. You get a more diversified and more robust portfolio, which will do better over time. That's one of the problems. Our industry, we've worked around it by using swaps or credit derivatives to get exposure to those type of markets. Just by saying those words, it's a negative backlash that people, oh, they got a swap, that's a bad thing. No, it's actually a good thing. It allows for a more robust program, better diversification.
Yeah, use it as a tool for diversification, access
Absolutely.
to markets you wouldn't otherwise have. It's hard for managed futures managers to look ahead and say, oh, we think the market is going to do this or that. So I'm not going to ask you to make any predictions for
Good.
2017. But I actually would like both of you to take a look back. Can you look back at your strategy and tell me about a theme that played out that went well for you last year, let's say, one that your models maybe picked up on before the headlines did?
2010, the credit crisis had happened. Interest rates were dropping like a lead balloon. And you sit in front of a room full of people and say, our system's still long bonds. Now, we're closing in on zero interest rates.
Were there still people in that room after you said that?
And, the thought process is, how in the world would you still be long bonds? Well, guess what? We stayed long bonds all the way through to the end of last year, and we made a lot of money being long bonds. Yes. And it just shows that not having that emotional involvement in the trade, it's very successful and it works. And like you said, there is no prediction mechanism. We're just reacting to what the market is telling us and taking what the market gives us. So people that oil, for instance, that was a great trade for every trend follower. We rode it all the way up. Nobody thought it could go as high as it did. Of course, Goldman and everybody's calling for record highs, and then it starts collapsing. Oh, it can't go below this, can't go below that, and it just keeps falling. The thing that's interesting about it, that oil price had turned and started going back up before we ever got out of the trade. So we lost money at the end of the trade. But that's how trend following works. The trend has to be proven to be over before we get out of the trade. So it's not predictive, it's always following.
Okay, interesting. So I want to move a little bit to each of your individual areas, understanding where your strategies fit in, what the benefit is to a larger portfolio. So I'm going to start with my two managed futures experts first. Marty, when you think about managed futures, give us a little bit of an overview into the types of managed futures strategies there are available and what the real value out of these strategies would be.
Well, I think the main strategy that's recognized is trend following, which is what we do and what the bulk of managed futures is. Now, there are uncorrelated managers within the space that are doing something different. We know that our belief is there's two patterns, basically, trend following and reverting type strategies. And then there's the short-term space, which there's some managers who have been fairly successful in that arena, very few that have done it over a course of time. There's been a lot of them that have done well 2 to 3 years, and then something happens and they just don't seem to perform after that. But my belief is if you're building a portfolio, managed futures should have a place in that portfolio. What we tell people in the efficient frontier in terms of risk-adjusted performance, they should allocate about 20 to 25% of their risk to manage futures, not AUM, but the risk of their portfolio. And then within that space, I think you start with a core of trend following, which, maybe I'm talking my book, and then you build around that to get more diversification to build on your portfolio.
One of the things that came up when hedge fund long short equity, the big name guys were having some trouble, was that you have a lot of managers concentrated in big names and those stocks are swinging with their redemption from those stocks, et cetera. How do you think about that universe? Are you at all concerned about the large cap names being moved by forces other than market moves or the company itself?
I think that's even true in the managed futures space, though, because one of the things, even though we're systematic, from a risk standpoint, all managers in our space are looking at the size of their position in reference to the population as a whole. We as a firm don't borrow risk from one futures market to another. So, we're limited on how much risk we can have in any given market. We treat them all equally. And that can be key, because if you see a good trend, some managers will load up on that trend and basically plow into that trade, at which point in time they become a lion's share of that marketplace. And then if it reverts on them, they can get hurt pretty badly. So all these things are figured in, into the risk management aspect of what we do in the managers in our space. And for the majority of them are pretty good at it, because the ones who aren't don't survive. The other thing to understand is, when we do well is when everything else tends to do really poorly. The market crisis event. And if that happened today, the first month we're not going to do that well, because we're going to have to get out of those long equity positions, and then everything else will start adjusting and we'll start making money in bonds and other sectors along the way. And at some point we would actually get short the equity markets and then make money on that side of it. So that's why almost any time that you've seen a major market correction, managed futures has done well. And that's why people invest in that side of the portfolio. It's the insurance aspect. We're non-correlated except for during crisis events, and then we become negatively correlated, which is exactly what you want. And this is the problem with our industry. We do a terrible job of education.
With
that's
daily
what we're
reporting,
doing
it's
today.
hard.
Yeah.
Well, it is hard, but part of what we're doing here now is talking about this stuff to educate the investment public on how these strategies react in the markets.
We've alluded to this a few times, but I want to talk about performance measurement. How do you index your performance? Are you beating a certain benchmark, or how do you explain to investors to understand your performance?
We also, in our charts, we always show it with the S&P, but we usually benchmark against the B Top 50 or Barclays CTA index, just because they're large and we've been around so long and they've been around a long time, so we just kind of grew up with them, and that's how we've done it. I do think it's important to look at two aspects. Absolute performance is important. There's no question about it. But I do think risk-adjusted performance plays a major role, and people should take a look at that. So we try to show both.
Okay.
Against the index, though, we just show our performance to the index.
Now, if we're talking about performance, we have to talk about fees, and in the hedge fund world, that's a very contentious topic. So can you help me understand how a liquid alternative strategy creates fees, yours in particular, and then how that differs from the 2-in-20 model that we're so used to associating with hedge funds?
Well, I think, I always like to trumpet this because we're different than everybody else. We don't charge management fees.
Okay.
So we're 0 and 25. We charge an incentive fee. The emphasis for it was Bill Dunn, the founder of the firm, always wanted to be on the same side of the table as the investor. So he didn't feel comfortable charging people fees if they were losing money. And as he would say, we've never had anybody complain of paying us a fee, because they only pay when they're making money. So they win, we win, everybody's happy. It makes it a little difficult in the 40Act space because there are costs that are borne by who's sponsoring the fund. We act as a sub-manager. We don't have a 40 Act that's ours, and Arrow Funds is actually running our 40 Act, and so they charge whatever is acceptable in the industry. I think is fairly low. We purposely partnershipped with them because of their economical fee situation. We had been approached by a number of other people in the space, and we just couldn't agree with the fee structure, so we just didn't ever do it until at this point. But it's been a good partnership. You know, in the 40X space, and you can correct me if I'm wrong because I don't really know all the rules on it since I'm a sub-manager, but you know, they don't allow incentive fees. So you have to have a swap structure to do the incentive fees, so the swap passes through the net performance of our fund. I always tell people just focus on the net performance. I mean, all our performance numbers are net of fees, so that's all that's important. If I charged you 50% incentive fee and I outperformed the market, do you care? Most likely not, but I don't charge 50%.
So we're actually coming to the end of our discussion, and I want to give you each the opportunity to give us some closing thoughts, either about liquid alternatives as a whole or about your firm and specifically what you bring to the table. So Marty, I'll start with you.
Gee whiz. I think if you look at the space, like I said before, I think education is important, and we need to get out there and explain things to people, and just like you just explained about fees in the regulatory environment. I think secondly, bring us back to the regulatory environment. I think the regulators need to get an ounce of common sense when they're looking at this space, because the more options you have within the 40X space, the better it is for the investor and the better it is for the general public. So those are basically the two thoughts I'd like to leave, other than, you know, managed futures is successful. It hasn't done as well over the last several years. We've done well. I think you guys have done well. So you do your due diligence, pick a good manager, make an allocation, and make it part of your core portfolio, and don't try to time it because it's not going to work.